You watching this week?
It's been a quiet period here with the stock market. We're kind of seeing a flat morning here as well. The stock market has taken the latest inflation data, higher oil prices, and those UAW strikes pretty much in stride. In fact, stocks have had the second longest stretch without a 2% daily move in more than 15 years. In fact, last week, the VIX volatility index hit its lowest level since before the pandemic, briefly dipping below 13. So what might shake the market out of its quiet mood? I'm focusing on that this week, and it's the earnings pre-announcement season that starts this week that I think could shake up stocks a little bit. We know this is a period where companies who are not on track to meet their quarterly targets often let investors know the bad news. And with the global service sector deteriorating sharply during the quarter, we know manufacturing has been weak, but services really slowed sharply around the world in Q3. That could mean there's some potential bad news from that formerly healthy sector. And we got a highlight of that, or maybe a preview of that last week with the airlines. American cut its third quarter earnings guidance because of higher fuel prices. Spirit warned about steep discounts for travel as consumers face higher gasoline prices and the resumption of student loan payments and other factors. So I think airlines, maybe loss of altitude, their stocks have really gotten hit this month, may offer a hint of what the week ahead might hold for consumer businesses and businesses with oil as a big cost. So I'll be paying close attention to the sort of pre-announcements we often get here at the end of the quarter as things begin to wrap up. Also, of course, on Wednesday, it's a Fed week. We expect the Fed to hold rates at 5.5%. More important will be the clues it offers on the future rate path. We've seen a number of positive economic surprises here in the U.S. since the last meeting, and that will probably lead the Fed to sharply revise up their GDP growth forecasts. The market's pricing at about a 40% chance of another 25 basis point rate hike this year. We think the odds are maybe even a little higher than that. Maybe it's a 50-50 shot. I think we'll probably see the Fed dot plot, which always gets a lot of attention, as all the different members of the FOMC put in their opinion as to where rates should be this year or next year. That might shift up a little bit as FOMC members are looking to assure the markets that they remain vigilant on inflation in the face of still a very strong labor market. So we'll see what comes out of that. I think maybe a little bit of a hawkish tone might be what we hear from the Fed, though certainly not a rate hike. What else? So the Bank of England is also got a monetary policy committee meeting this week. They're probably going to hike rates by 25 basis points on Thursday to 5.5%, right where the Fed is. And that's probably their last move. The strength of wages is likely to be cited as the main reason for that move. But UK policymakers appear increasingly confident that rates are close to peaking and the economy is now flirting with recession here in Q3. So that's probably their last move. And then on Thursday, I mentioned the job market. Initial claims for unemployment benefits in the U.S., I think, are going to be more closely watched than a usual weekly reading. And that's because they're going to reveal if they continue to trend lower in the third quarter, suggesting resilient strength in the job market this summer after they were rising in the first half of the year. All signs were pointing to the labor market, beginning to show some signs of weakening, and then that's really turned around over the summer. So we'll see if that's just seasonal adjustments or if we're actually seeing some real firmness in the job market, almost surprising firmness here as other parts of the economy slow down. Then finally, Friday, we get the Purchasing Managers Index, the previews of those for the month of September. We're going to get those for the U.S., Germany, France, Japan, and Australia, and the U.K. It gives us our first read on manufacturing activity in September. The last reading in August surprised with a slight improvement. So even as services have come down, manufacturing has stabilized a little bit and ticked up. We'll see if that trend continues here as we get to that data on Friday.
Okay, well, you highlighted in your previous comments, a risk to the market's calm, but there was a big IPO last week, ARM Holdings. Does that signal any positive change or potential change in the market environment or sentiment?
Well, it's always good when a company feels it can come to the market. It's sort of a little bit of a sign that they feel that there is some confidence in that the market can absorb that IPO. But I think the ARM IPO last week is just another sign of investors' AI stock obsession, artificial intelligence obsession, kind of bucking the overall trend, right? ARM is able to come to market even as IPOs are in a recession. There is an IPO recession going on right now. The value of global IPOs in recent months is the lowest since the 08-09 global financial crisis. And I don't see that changing. Companies are just not looking to raise money right now, given the sluggish global backdrop. Q3 GDP is likely flat to negative for Germany, Japan, and the UK, and isn't much better in China. That makes 4 of the top 5 economies in the world having soft demand. So I don't see a new wave of IPOs, or that last week's IPO was a sign of the market broadening. The opposite. Actually, it had this chart of of IPO volume, and you can just see how it's really dropped off so sharply, and really back to kind of these levels that we really haven't seen sustained for any period of time since '08, early 2009, right? The worst part of the great financial crisis. That's how dried up the IPO market is. So, I think as we think about what does this really mean, I think the market, it's just really telling us that the market's obsessed with AI stocks, and an AI company can come to the market in the middle of an IPO recession. On the last show, I highlighted how US stocks would be flat this year without the gains from the top 7 mega cap tech stocks, all of which are tied to AI. But here's a chart. It shows how central banks' balance sheets tend to drive the markets. We know that the central banks provide a lot of liquidity. A lot of that goes into the stock market. They tend to drive markets, and that's what you see here in the orange line being, a regression using just central bank balance sheets. The blue line is, what stocks are actually doing, and you can see this divergence here, really for one of the few times in the last 10 or 15 years, we've seen a divergence between what central banks are indicating the market should do and what the market's doing. And it's really, I think, almost entirely driven by the AI stock frenzy there, as the S&P kind of levitates away from what the Fed and other central banks are doing. So I still see this as a market obsessed with AI as a theme.
All right. Now, you mentioned that China's growth is not looking that great. Now, we've talked a lot about that on this show over the weeks. So what's the latest over there?
Well, global stocks really suffered in August around the world, really tied to that weaker Chinese economic outlook. China's growth problem, as we've talked about, lies in its property market, which is estimated to contribute almost a third of GDP in recent years. And developers' actions and comments are suggesting that they are starved of capital. They had too much capital before. Now they have very little because of these regulations that have been imposed upon them. And debt issuance is a problem. Cash flows from new property sales are plunging. And so concerns have increased about losing down payments, which are typically made years before delivery of a completed house or housing unit. And because property comprises about 70% of the wealth of Chinese households, worries about the housing market appear to be eroding overall consumer confidence and the pace of spending on goods. You can see here in this chart of consumer confidence in China how it plunged with the lockdowns in 2020, but that also corresponded to further tightening in the housing market. And just it started a rebound as they showed signs of reopening, and then rolled right back over again as the housing market, where again most of the wealth of Chinese households is concentrated, really weakened up. So the economy reopened, sentiment is right back where it was during when it was locked down. So to address this housing-driven downturn, China's enacted an almost daily drip feed of targeted stimulus measures, especially since the July Politburo meeting. And as these incremental policy measures began to bear fruit in August, we've been talking about some positive surprises in the September releases of official August data. We've been pointing to this unseasonable rise in China's air pollution as a renewed sign of China's manufacturing activity. And even as economists have been obsessed over the lack of massive stimulus coming out of China, those incremental moves have really started to bear some fruit. The manufacturing PMI came in at 51 versus 49.2 in July. So 51 in August, back into expansion territory in China. Retail sales grew 4.6% in August after only 2.5% in July. Industrial output, industrial value added growth accelerated to 4.5% year over year in August. CPI came back from deflationary. It was negative 0.3 in July, back up to just 0.1 in August. So inflation ticking back up again. Export terms, exports in local terms fell a little bit, but they were improving from the July drop. New loans, huge surge in new loans in August. Property sales decline narrowed a little bit. Construction starts decline narrowed a little bit. The unemployment rate fell. So all this is pointing to some incremental improvement in China's economy. I don't expect a V-shaped recovery because of this property market overhang, but more stimulus announcements and upward surprises continuing, suggesting that these stimulus measures are beginning to work, could lift sentiment and stocks with China exposure. Chinese stocks are about in line with the S&P 500 this quarter.
Interesting. So the U.S. economy does seem to be doing better than a lot of other countries you've mentioned. Is that a reason for focus, maybe overweight the U.S., or what do you think about that?
Yeah, I get this question a lot, and the U.S. is really pulling ahead of many other countries. Economic data for the U.S. is now tracking close to 5% GDP growth for here in the third quarter. That's an annualized number, but a 5% number. That's according to the Atlanta Fed's GDP Now forecast. You may hear this a lot. The Atlanta Fed just simply tracks the data that make up GDP as it's reported throughout the quarter. Much of that data is reported with a little bit of a lag. Some of the weaker data is reported with a little bit of a lag. So I'd expect that number to come down a little. It took down a little. That's the green line there. The blue line is the consensus of economists. So they're still pretty far apart on where they think the quarter is going to end up. But clearly, economists have been trending higher here for the third quarter. And certainly the GDP Now numbers are very high for Q3. In contrast to that, the data for Europe shows that economy might be back in recession in Q3. I mentioned the weakness in Germany, but the stock markets are still favoring Europe, with the average European stock outperforming the average US stock this year. And there's kind of a tie in that race so far here in the third quarter. So why the weak economy, yet strong stock market in Europe, at least compared to the US? And I think it all gets down to sentiment. The Eurozone's economic indicators have continued to surprise on the downside since April. There's no sugarcoating it. The European economy has been slowing. The Purchasing Managers Index fell to 47 from 48.5 in July. The Services PMI unexpectedly dropped into contraction territory alongside the Manufacturing Index. In fact, Germany, the largest economy, factory orders for July fell the most since the lockdowns in 2020 during the pandemic. The consumer confidence recovery stalled in August, and it remains below its long-term average. So there's been a lot of weakness there. The economic surprise index for Europe has been below zero since April. So this is this chart here. The red shows where data is coming in worse than the economists forecast. Green is where it's coming in better than they forecast. It's been below forecast since April. So just the data is not only weak, but coming in consistently weaker. So in short, this modest momentum we saw in the Eurozone economy in the second quarter, when real GDP grew 0.3%, that's not an annualized number, so like 1.2% on US terms, that seems to be evaporating in Q3. So does that mean the European Central Bank hiked rates too far in their efforts to slow demand and cool the inflation? I don't think so. The European Central Bank has hiked rates into that 4 to 5.5% range of other major central banks. When we adjust the policy rate for core inflation, though, to determine how restrictive the rate actually is, we get the orange columns, right? So that's the policy rate net the rate of core inflation. Let's talk about the real policy rate here. It's still negative by 80 basis points, and that's below neutral and nowhere near the positive 130 basis points we see in the US. And US growth is surprising on the upside. So I don't think it's just that the ECB has been too tight. There's an argument you could make, but relative to the US, it's not there. And US growth has been doing okay. So no, I think there's a real slowdown here in Europe, and hoping that'll turn around in the fourth quarter. There's some signs that things are improving, particularly as China picks back up again, which is a very important end market for Germany and a number of other European countries, biggest trading partner. But more importantly to us as investors, the performance of Eurozone stocks doesn't seem to reflect this extended string of disappointing data. Again, because sentiment has been so weak. The markets expected the data to be very bad. The average European stock, measured by the equal-weighted MSCI EMU index, that's a European Monetary Union index, so it's the Eurozone, is down from this year's peak at the end of July, but it's not broken out to the downside. Instead, it's kind of traded sideways over the past 5 months that the economic surprise index was below zero. So despite data coming in below economists' expectations was below investors' expectations. They were kind of braced for a weak economic environment. The average European stock has maintained its outperformance of the average US stock so far this year, despite that big gap in economic momentum. So, in contrast to the US, where an upbeat growth outlook by investors supports an above average PE for the S&P 500, investors in Europe have been valuing European stocks well below the long-term average. In fact, you can see it here in this chart. So the orange there are stocks in Europe, and the dotted orange line is the 10-year average PE for stocks in Europe. Usually stocks in Europe trade below those in the US because of sectoral differences. A lot less tech in Europe, which is high PE sector, a lot more financials, which is a low PE sector, and energy, others. But you can see it's well below its average, whereas in the US, the S&P 500 is trading above average. Again, U.S. investors expecting strong economic data, European investors expecting weak economic data. That's the key there, and explains the difference in performance and why we've been more optimistic on European stocks, because sentiment is so weak. Not only reflected in valuations, but reflected in investment surveys as well. If we take a look at Eurozone economic sentiment by investors tracked by Centex, it's currently dismal. The confidence index is near recessionary lows here in August. Global investors are no more cheerful than that. In fact, according to the Bank of America's most recent monthly survey in August, the net percentage of fund managers expecting European stock markets to weaken over the coming months climbed to 71%. So this suggests any improvement in confidence could provide a lift to European stocks, which are pricing in a recession at this point. Investor expectations for Eurozone growth may already be so low that they just can't push the stocks down any further. And investors willing to kind of look beyond the current weakness could start to drive up PE ratios. Counterintuitively, I'll just close with this, a catalyst could include even more disappointing economic data, because if the data were considered weak enough to persuade the European Central Bank to stop unwinding its quantitative easing, to stop quantitative tightening that began back in March and start cutting interest rates sometime soon, that could be seen as good news for the markets. Other developments that could be seen as catalysts on the upside for Europe's economic upswing could be more effective stimulus in China, right? That's one of the reasons why we've seen things do a little bit better here lately. A rebound in European consumer spending as rapid disinflation pushes up real incomes, or the restoration maybe of that grain deal between Russia and Ukraine. I know there's behind the scenes work going on to kind of restore that export deal, and that would ease food prices in Europe that are currently the largest component of overall Eurozone inflation. So there's a number of things that could go that way, but sentiment is so bad on Europe right now that I think this outperformance of the average stock in Europe is explained simply by expectations being so low.
All right, well, we've got some questions coming in here. So the first is, if our economy is doing better than other places in the world, would that support the price of the dollar?
Yes, it would in general, for a couple of reasons. One, there's more interest in investing in the US by the rest of the world, so they buy dollars to do that. And two, because it suggests that the Fed might need to hike rates more or hold rates higher for longer than other central banks. And so, because a lot of what drives the dollar is where you're going to get the best yield on your cash. If the idea is cash yields might be higher for longer in the US, then investors will be more interested in buying dollars to hold short-term fixed income assets in the US. So yeah, it should support the dollar. And so that's why we've seen more dollar strength here in Q3. In general, it's a relatively flat year for the dollar. I'm just pulling it up on my screen. So the dollar's up 1.6% in the trade-weighted dollar this year. The euro is only down 26 basis points year to date versus the dollar. So relatively flat environment, but this was a year where we thought the dollar would decline 2 or 3%. It had been declining, but that's turned around here on the idea that, growth is just quite a bit stronger in the US than elsewhere, and that might keep the Fed a bit more hawkish.
All right, you had mentioned the Atlanta Fed GDP. Do you think that thing is going to roll over or not? I mean, I guess that's the soft landing, hard landing idea, right?
Yeah, I mean, it's likely to come down a little bit. Trade data and some manufacturing output data is usually more lagged than a lot of the other components. So a lot of the strong components of GDP, which are reported on a real-time kind of monthly basis, are doing pretty well. It's those like trade is reported with like a 2-month lag, and industrial production with a long lag too. Those are weak. Manufacturing and trade, as I've talked about, there's a cardboard box recession going on. Those are the weaker parts of GDP, and they're not yet included in that GDP now estimate, at least not in total. So that might drag that number down, but it's around 5%. So even if that were to bring it down a 2%, it's still a 3% growth rate for GDP. Most economists are looking for something around 2. So yeah, I mean, coming in at 2 or 3% in a global environment where most of the other top 5 economies in the world are barely positive, that's a pretty good number. So yeah, I do think it's going to come down a bit, but certainly nothing. The third quarter is not going to feel like a recession. It's not going to feel like the recession has come out of manufacturing and trade and begun to affect the services sector. In fact, I think it's going to look like the economy, still most of the U.S. economy, which is devoted to services, is still doing okay.
All right. You had a chart there about policy rates, and can you explain the difference between a policy rate and real policy rate, and also what's considered restrictive and not restrictive?
Yeah, great question. So, the Fed and other central banks have a policy rate. We call it the federal funds rate here in the US. It's got different names in different countries, but it's their main rate, usually tied to very short-term interest rates. And we tend to report that on an absolute basis. The Fed is at 5.5% right now. But what really matters, whether it's stimulative or not, uh, is what's the rate of inflation. If inflation's at 15% and the Fed's only got, a 5.5% policy rate, well, that's still very stimulative. You could borrow at 5.5% and essentially, just invest in something that's getting the rate of inflation to get 15. So that's encouraging investment. It's when that rate is higher than the rate of inflation that it's restrictive, that it's more costly to borrow than what you're going to get just from inflation on your sales. So that's what we call it restrictive. Usually we look at core inflation for that historically rather than headline inflation, because headline inflation can swing from one month to the next based on energy or food or just some kind of supply disruption that's temporary. So we tend to use core, although you could use either. The chart I showed used core inflation, which is now very close to what headline inflation is as well. So when we subtract that out, what we see is that it's slightly restrictive in the US by about 1.3%. When we look at in Europe, it's not. It's the other way. Inflation's coming down more rapidly in Europe now than it is in the US. So I think that'll get there, and that's why the European Central Bank doesn't have to hike rates much more, because inflation is kind of doing the work there. And as that comes down, the policy, or even if they don't change the policy rate, as inflation comes down, the real policy rate gets more and more and more restrictive on the economy. It makes businesses not want to borrow. You're not going to want to fund more inventory if what you're going to get, if you have to pay more to finance that inventory, then you're going to get selling it because the price of it isn't going to change. So that's the idea behind it, and why policy rates work the way they do. It's all about their relative rate relative to inflation. We've been in 10 or 20 years where inflation was low and stable. So we really only just talked about what the actual rate was instead of its real rate, the actual effective rate, if you will, the real policy rate. Now, with inflation having done what it's done, far more important to focus on that effective rate of inflation. And that is slightly restrictive in the US, Canada, a few other places, but it's still relatively not restrictive yet in Europe. But I think with inflation coming down as sharply as it is, it will be restrictive without the European Central Bank having to do anything else.
Interesting. So what do you think about the impact of China's stimulus on oil prices? It seems like oil prices have been going up more on the supply side than the demand side with what they're doing. But apparently one of our clients follows you on X or Twitter, and he said you tweeted a week ago that it looks like it's following 70s inflation. Do you see us following the same trend?
Yeah, so I put a chart out a month or two ago, about sort of the pattern of U.S. inflation and what we saw in the 70s. And I did it for a bunch of different countries, and they all line up pretty well. But the U.S. one caught the attention of former Treasury Secretary Larry Summers, and he retweeted it, and it got, reposted it on X, and it got a lot of attention. I think he's put more attention or puts more credibility in that chart than I do. I think it's interesting that we're following the 1970s pattern. I do think that inflation is bouncing here, as it usually does. Inflation rarely comes all the way back down again in a straight line. Usually you get a bounce at some point. We did in the 90s, we did in the 70s. We've done a few points over time where inflation ticked up. We did after the 08-09 cycle where inflation had ticked up. So it's not surprising to me in the last 2 months that inflation has ticked back up again. I don't think it's going back up to all-time highs, but certainly moving up a little bit here on, some sticky housing inflation and food prices moving back up. And yeah, oil too. It is more of a supply issue, but yes, demand, if China's really effective in stimulating its economy, then yes, oil demand could come back in a more significant way. I'm not so sure. Frankly, I don't have any trustworthy data on oil inventory in China. I don't know what oil inventories are in China. They may have been stockpiling it so that as their economy reaccelerates a little bit, they don't need to import a lot more because they've basically been importing a lot of it and sitting on it as their economy slowed down. But I can't be sure of that. There could be an uptick here in Chinese demand. We do know it's been more supply than demand that's been driving the price up a little bit. I think as the price goes much higher, I'm just looking at my screen. So I'm looking at a West Texas Intermediate right now trading at $92.11 on the front month futures contract. I think as we get close to 100 on that, over 95, I think you see that supply discipline break down. I think you see Russia, a few others begin to produce and pump more. And so that supply dynamic changes. I don't think demand is likely to see a V-shaped recovery in China. It may improve slightly, but the more important factor is supply coming back online after they feel they've been successful in defending oil prices and getting prices back up to a level where OPEC Plus feels it's getting a very good return on its investment.
Okay, and the last one here, we have time for one more. So how important is the dot plot in this meeting when the Fed policy is data dependent?
Great question. I don't know. I think the market's going to put a little bit of weight on it because they're looking at because it's going to move up probably a little bit, and so the FOMC is probably going to signal to the markets that they're not convinced that they're done, that they may need to do a little bit more. But I think the market knows that that's really dependent upon the data. Just because the Fed thinks the data is going to remain hot, the economy, the job market, doesn't mean it's actually going to remain hot. So I think the market takes with a grain of salt that the Fed is indicating they're worried that the risk is to the upside on inflation from here rather than the downside. But I think the market is still fairly convinced that inflation has peaked. And even though we've got a couple of months of inflation ticking back up again, it is stable and will be coming down over the next 6 months. And the Fed will probably be cutting rates next year, even if the Fed isn't entirely convinced that that's going to happen. So, yeah, I don't know. I don't think they're going to read a lot into the dot plots for 2024 or 2025. Those are way too far out and way too distributed right now. But I think as they look at 2023, knowing there's only 3 months left, the market's interpretation is the data is soft enough that the Fed doesn't need to hike. But of course, as I just mentioned, the data has firmed up here in the last month or two. And so I think there will be a little bit of a debate. There is some risk on Wednesday that the Fed will sound more hawkish and more committed to a bias to hike, even in the face of relatively benign data. But I think overall the market is still 40% convinced that there's another rate hike, 60% convinced there won't be. But given how closely divided that is, every data point is going to be parsed pretty closely and could create some volatility.
All right. Well, our time is up. So thank you, Jeffrey, for all of your insights. But you can get ongoing insights at Jeffrey Kleintop on Twitter X. And you can get replays of Jeff's World on the calendar. Just look for the replays there, and you can watch them anytime that you want. You can also check the calendar below for all of our upcoming events. Take care, everybody. Good luck with your trading.